Imagine being a manager, lost in a sea of decisions, with only a spinning compass for guidance. Every choice feels uncertain, every step a guess. In business and governance, that guiding compass is called operating parameters. In accountancy, these are the core principles and rules that define an organization's mission, shape its strategy, and determine how success is measured. For accountants, understanding operating parameters is essential. For example, a private company may focus on maximizing profit, while a public organization prioritizes service delivery and public value. Knowing these differences helps accountants align financial practices with organizational goals. Let's break it down. In the private sector, operating parameters revolve around profitability, efficiency, and shareholder value. In the public sector, the focus shifts to service quality, equity, and public accountability. Picture a classroom where future accountants learn to distinguish these domains. Both sectors use the same resources, capital, labor, and technology, but their ultimate goals are fundamentally different. For example, a private sector accountant might focus on cost control and profit margins, while a public sector accountant ensures funds are used fairly and effectively for community benefit. Understanding these operating parameters empowers accountants to make better decisions, support organizational strategy, and drive meaningful results. Recap: private sector aims for profit and efficiency. Public sector aims for service and equity. As an accountant, knowing these differences is your first step to becoming a trusted advisor. Let's first enter the world of the private sector. Here, the core operating parameter is clear, unambiguous, and relentless: maximizing shareholder value. But sophisticated managers know that simple net profit doesn't tell the whole story. The real question is, are you creating true economic value? This is measured by economic value added, or EVA. Let's break down EVA step by step. EVA is calculated as net operating profit after taxes, or NOPAT, minus the capital charge. The capital charge is the total capital employed multiplied by the cost of capital. For example, imagine a company with a NOPAT of 100 crore rupees, capital employed of 500 crore rupees, and a cost of capital of 12%. The capital charge is 500 times 12%, which equals 60 crore rupees. Subtracting the capital charge from NOPAT, we get EVA equals 100 minus 60, which is 40 crore rupees. A positive EVA means the company is creating value for its shareholders. If your company's investors expect a 12% return, and you only deliver 10%, you may have a positive accounting profit, but you have actually destroyed shareholder value. So how does a private sector manager achieve this? By focusing on a dashboard of critical key performance indicators, or KPIs. First, profitability, measured by metrics like EBITDA Margin. This shows your core operational efficiency. You improve it by controlling costs, negotiating better with suppliers, and optimizing processes. Second, efficiency and returns, measured by return on capital employed. This reveals how effectively you are using the company's assets to generate profit. You also obsess over the working capital cycle. This is the time it takes to turn your operational investments back into cash. A shorter cycle frees up cash for growth. Finally, growth and market position, measured by the ratio of customer lifetime value to customer acquisition cost. A sustainable business requires that customer value far exceeds acquisition cost. Let's recap. The private sector's key KPIs are profitability, efficiency, working capital cycle, growth, and economic value added. Mastering these ensures you are truly creating value. Quiz time. Which metric tells you if your company is truly creating value for shareholders? Is it A, net profit, B, economic value added, or C, revenue growth? Pause and think before you answer. Now, let's shift to the public sector. Here, the operating parameter is not profit. It is public value and service delivery. Success isn't measured in rupees of profit, but in quality and impact of services. The key financial parameter is value for money, evaluated using the 4 E's. Let's break them down. Economy means spending less. Think of a government hospital negotiating lower prices for medicines. Efficiency is spending well, like a city using technology to reduce waste in public transport. Effectiveness is spending wisely, such as a vaccination drive that actually improves public health. And equity is spending fairly, ensuring that rural schools get the same resources as urban ones. For example, when a municipality sources affordable buses, that's economy. When those buses run on time and serve more people, that's efficiency. If the service actually reduces commute times and improves quality of life, that's effectiveness. And if the routes are planned so that all neighborhoods, rich or poor, are served, that's equity in action. The KPIs for a public sector manager reflect this different mission. Their dashboard is not about margins, but about impact. Under service delivery, they track accessibility and equity. Are our services reaching the most vulnerable? They deploy mobile units and open new centers to close gaps. Under finance, they use outcome budgeting. This shifts focus from spending allocated budgets to achieving specific, measurable social outcomes. Under accountability, they're measured on transparency and compliance. They operate under public scrutiny, ensuring every process is transparent and fair. Let's recap. Public sector KPIs focus on service accessibility, equity, outcome budgeting, transparency, and compliance. For accountants, understanding these KPIs is crucial. They guide how resources are allocated, how success is measured, and how public trust is maintained. Quiz time. Which of the 4 E's is best demonstrated when a government ensures that all citizens, regardless of income, have access to clean drinking water? Is it economy, efficiency, effectiveness, or equity? In today's mixed economies, like India, the boundaries between public and private sectors are increasingly blurred. Public-private partnerships are now common, requiring private managers to consider not just costs, but also service quality, public safety, and social responsibility. For accountants, this shift means adapting to new frameworks. You must understand both financial discipline and the broader impact of your work, how your reporting supports transparency, compliance, and value creation for all stakeholders, not just shareholders. The rise of ESG, environmental, social, and governance investing has transformed the landscape. Companies are now measured not just by profit, but by their environmental footprint, social responsibility, and governance standards. Let's break down ESG metrics. Environmental metrics track carbon emissions, energy use, and waste management. Social metrics cover employee well-being, diversity, and community impact. Governance metrics assess board diversity, ethical conduct, and transparency. For accountants, integrating ESG means developing new reporting skills, ensuring data accuracy, and helping organizations meet regulatory and stakeholder expectations. Your role is evolving from scorekeeper to strategic advisor. So, what does this mean for you as a manager or accountant? Understanding your organization's core operating parameters is your first duty. But the truly modern professional is ambidextrous, able to balance financial rigor with social and environmental stewardship. Let's recap. The private sector focuses on shareholder value and efficiency. The public sector prioritizes service delivery and equity. Today, both must also address ESG concerns, making your role more dynamic and impactful than ever. Quick quiz. Which of the following is not part of ESG metrics? A. Carbon emissions. B. Employee well-being. C. Board diversity. D. Product pricing. Take a moment to think. The answer is D. Product pricing. Mastering operating parameters, including ESG, equips you to lead in any sector. Remember, your North Star is essential, but true mastery means navigating every point on the compass. Let's bring it all together. In this module, we explored the distinct roles of the private and public sectors, each with their own priorities and operating parameters. The private sector drives efficiency and shareholder value, while the public sector ensures equitable service delivery and public welfare. We learned that in today's world, these lines are no longer clear-cut. Public-private partnerships and the rise of ESG, environmental, social, and governance, have reshaped expectations for managers and accountants alike. You're now expected to blend financial expertise with a deep understanding of social and environmental impacts. Key definitions included operating parameters, your organization's core rules and priorities, and ESG metrics, the new standards for measuring environmental, social, and governance performance. Your main takeaways? Whether you work in the private or public sector, Mastering both financial discipline and social responsibility is essential. Your evolving role demands adaptability, ethical judgment, and a commitment to transparency. Before you move on, take a moment to review your notes. Make sure you're clear on the differences between sectors, the meaning of ESG, and how your day-to-day work supports broader organizational goals. When you're ready, head to the LMS and complete the quiz to test your understanding. This is your opportunity to solidify your knowledge and demonstrate your readiness to lead in today's complex environment.